All right, it is Friday, March 27th, as I'm recording this. And in the past couple of videos, I've said a little bit about portfolio diversification. I do want to take a moment today and discuss that, not get too much into current events. Nothing really I can add to the whole cacophony today. Diversification is something that smooths your returns over time. As I said the other day, it does mean you will be owning the best performing asset classes, stocks, and bonds at any given time. You'll also be owning some asset classes that don't perform as well, but that's okay in the long run because nobody has proven they can consistently pick every single winner, time the market correctly, buy and sell at just the right times. It's also very expensive to do that kind of stock picking and market timing. And if you're looking at a taxable account, then forget about it. You can really incur some serious capital gains if you're trying to do that. That's particularly true in a better market, but even today, as I mentioned in a video earlier this week. So, diversification, in a nutshell, is a risk management strategy that uses various assets, I'll talk about those in just a minute, to reduce overall portfolio risk. Okay, here is a look at some asset classes. This is not meant to be all inclusive, okay? So it includes large domestic stocks. So that's the stocks we all know about: Apple, Microsoft, Facebook, Google, Amazon, to name some of the big techs. Of course, ExxonMobil is a big one that's out there. All the different publicly traded companies, the big ones with the largest market capitalization. Large foreign stocks, same thing. A lot of the pharmaceuticals are some of the bigger foreign stocks. These are ones you want to own as well, because occasionally, not so much lately as in the past, but sometimes different markets, say the German market, for example, or the British market, might perform differently than the US. Lately, yeah, the big developed nations do tend to kind of move in tandem, although Europe did underperform the US for a period of time not that long ago. But you do want all of these because you never know when one is going to perform better than the other. Trying to pick the winners, that's market timing. Trying to get in and out of a stock or a fund when you think it's going to tank or show a rally, that's market timing. You don't want to do that. It's an expensive, ultimately pointless and stressful endeavor. Small domestic stocks, small foreign stocks, sector diversification. You also want some bonds. I didn't put that here. Short-term, high-quality bonds. You want those as well. Okay, a lot of words on here, but portfolio diversification, it slashes your volatility because not all these things perform the same way at the same time, right? I mean, you might have tech companies performing really well, while, for example, consumer staples might be not performing as well. I talked about consumer staples the other day. Yes, that's toilet paper, paper towels, all the stuff flying off the shelves right now, toothpaste, shampoo. You get the point. That's going to perform as a different category than tech, okay? This type of diversification means they're all rising and falling at different times. Smooths out your returns ultimately, really makes for a much less stressful and ultimately, the proof is in the pudding, ultimately more profitable investment strategy than just trying to trade in and out and guess what's going to be the winner at any given time. So I'm going to give you right now a ridiculously basic example of how different asset classes can perform differently. I've shown the S&P 500 index several times this week. It's just a big index, the 500 biggest US stocks. It's one that many US investors are familiar with. If you look at any kind of market report on the internet or they show something on television, they're almost certainly going to talk about the S&P 500. Unfortunately, they also talk about the Dow. You'll hear that. That's just 30 US stocks. I don't know why they keep talking about it, mostly because the people giving these reports often don't know what they're talking about. Really, the S&P 500, in my view, is a better indicator of overall large domestic stock performance than the Dow because it includes 500 stocks, not just 30. Okay, so right now, The market is still open. It's about 1:15 Mountain Time as I'm recording this, so we have about 45 minutes left in the session. Now you do see over here where you see where that little crosshair is up at the near the top of the trading session for today. That means we're still way down from the day from where we closed yesterday, but the S&P 500 has moved higher in the session. Not a bad sign. But again, as you know, I'm not getting too excited about any type of uptrend I'm seeing right now. Now, this is the S&P 500, big domestic stocks. I talked about that on one of the slides just a minute ago. You want to own these. Let me go over here and show you the S&P 600. So these are small US stocks, okay? I talked about that just a second ago. You want to own large domestic stocks, small domestic stocks, same is true for foreign stocks, both developed and emerging markets. I'll talk about that more some other day. But lo and behold, look at this. Remember how we had the S&P 500 of large domestic stocks was down for the session? Look at this. This is up for the session and right up there at the top of its trading range. Oh, and by the way, it is looking as if trading volume might come in heavier than in the prior session. Let me just take a look at that. Let's see. It's already looking higher than in yesterday's session. So that's a good sign for small caps. You're seeing a pretty good rise there in heavier than average volume and trading volume heavier than yesterday. Okay, this is just a super duper elementary, very simple example of why you want to diversify from the large domestic stocks, which are down for the day. Even these two are at the top of their trading range. And small domestic stocks, which are up for the day. Why? Because if you would just have the S&P 500, your portfolio would not have exposure to these gains that are happening today. And remember, there are many, many, many more asset classes here. I'm not suggesting you only own the S&P 500 and S&P 600, but you certainly do want exposure to the stocks in both of these, okay? Very, very basic lesson on diversification today. I am going to do more on this probably next week. Just wanted to kind of dip our toes in here today so you do get a sense of what I'm talking about when I say this. All right, thanks again for watching. Have a great weekend. I may or may not be back with some more videos over the weekend. Since we're all homebound, very likely I'll feel like doing one. And stay safe out there, everybody. Thanks again for watching.